The subject of this video will be my thoughts on the robust stock market rally today, August 22nd, 2025. Prior to today, bond investors were pricing in a 25 basis point cut in the federal funds range next month. The probability varied over the past couple of weeks, ranging from about 80% to 95%, and was at 95% about a week ago. Currently, when I last looked at 3:10 Central Standard Time today, the odds were at 83%. So nothing happened in the world today that changed the bond investors' perspective about the probability of a Fed rate cut in September. Apparently, stock investors were unaware of those odds and responded to a statement today made by Powell as if it was a revelation to them. Powell did not promise a rate cut in September, but did note that the weakening labor market, which President Trump claims does not exist, may justify a rate cut next month. The 3 to 6 month Treasury bills have been pricing in a 25 basis point cut in the federal funds rate for some weeks now at the weekly auctions. Remember that Trump fired the BLS commissioner after the poor July jobs report and the major revisions to the prior 2 months, since she did not change the employment data compiled by the career statisticians at the BLS. And Trump was claiming that he knew the data was wrong since the economy was, quote, booming, end quote, all capital letters. So Trump may get the rate cut that he desires, not because the economy is booming as he claims, but is faltering and may be moving toward a recession due to his policies. Once it is recognized that the odds prior to today of a Fed rate cut at the September meeting was near 100%, and that's prior to today, it is hard to justify the reaction and the stock market to Powell's comments. Yet the next CPI report, which will be released just prior to the Fed meeting in September, shows an increase in the core inflation rate, which was last reported up 3.1% for the 12 months ending in July. Then the Fed needs to wait on lowering the federal funds rate. If the Fed cuts when inflation is rising, then the impact could easily be counterproductive, in that intermediate and long-term rates may rise in response, similar to what actually happened after the Fed started to cut in September 2024, with the 10-year Treasury rising about 100 basis points in yield from mid-September to early January 2025. After cutting by 50 basis points in mid-September 2024, the Fed then had two rate cuts of 25 basis points each before year end. And during that period, the 10-year Treasury yield went much higher. But it is just my opinion that preventing the onset of problematic inflation is far more important for the Fed than cutting interest rates when inflation is rising to address a weakening labor market. As I recently mentioned, I started to invest in the late 1960s when problematic inflation was in full bloom and ended up causing, I should say, a 17-year bear market in both stocks and bonds. The average annual return of the S&P 500 with dividends reinvested was minus 1.83%, adjusted for inflation, starting in January 1966 through July 1982. I will cite a source for that data in the board section below. So when you live through something much worse over a much longer period of time than what the nation experienced in 2022 and 2023 and 2021, then you can understand my perspective on whether problematic inflation or unemployment rising is the major concern, or should be the major concern for the Federal Reserve. The Fed contributed to the high inflation numbers starting in 2021 by creating an excessive amount of money as part of its ongoing QE program, where it creates money to buy treasuries and mortgage-backed securities and took its balance sheet at one time over $9 trillion, and continuing ZIRP, zero interest policies, even when inflation was spiking. I was saying in 2021 that the Fed was so far behind the curve that it needed a telescope to see the curve, but Powell was saying then that it was all transitory. Well, inflation spikes in inflation may be transitory, but once they're embedded in the system, it's not like they're going to go back down. The rate of increase may slow. And if you get a prolonged period of problematic inflation, like I went through and when I started to invest until the early 1980s, then it sticks around forever. I do not have any short stock positions. I am a long-only cash investor. I do not borrow money to buy anything. So I benefited by the rally today in stocks and bonds to a lesser extent. My individual common stock positions generally fluctuate in the 200 to 250 range, but the allocation is less than 10% of my total assets held in my brokerage accounts. I'm primarily invested in bonds and cash and money market funds at the present time. As I've said in the past, I did not buy a bond prior to 2007. And now I own close to 400 different corporate bonds. So I also own some stock funds, but I've been pairing those. I am continuing to sell corporate bonds maturing in 2032 or later, since I believe that investors are underpricing the onset of a higher inflation rate later this year that could easily accelerate significantly throughout 2026 and 2027 based on more of the Republican tariff taxes being passed on by companies and consumer prices, accelerating disruptions in the supply chain causally related to the tariffs, particularly the 50% Republican tariff taxes on the metals and products that simply include those metals, as well as disruptions caused by the deportations of unlawful immigrants who perform critical jobs in the U.S. supply chains, including agriculture. So if I'm right, and I can't predict the future, I can only make my best guess and then design my asset allocations accordingly, is that if the Fed cuts rates when inflation is rising and inflation continues to rise with no Fed rate increase, then the result could easily, as I said, be counterproductive in that the intermediate and longer term rates would rise in response to that scenario.